Hi everybody. I wanted to go over a couple of terms that you'll be seeing in this chapter that tends to confuse a lot of students. And those are accounts receivable and accounts payable. As I've seen from looking at the homework assignments previously, this can tend to be confusing for students, so I just wanted to take a few minutes to clarify both of these terms. So let's start with accounts receivable. Accounts receivable occurs when a business will extend credit to a customer that it has provided services or a product to. Now, in this case, no cash is received, and since no cash is received, an account called accounts receivable is set up. Now, accounts receivable is an asset account since, according to the definition of an asset, it will provide future benefit for the company. So in this case, the service is provided and the customer promises to pay in the future. But again, no cash is received at this current time. In this case, the asset accounts receivable is increased because the person is now owing the company, the business, money. So accounts receivable, that key term receivable, meaning we are to receive it in the future, is increased. In addition, because we have provided this service or product, the equity account called revenue is also increased because we're increasing our revenue. Now, remember, and we'll see this more clearly, but a debit will increase an asset account. A credit increases the equity revenue account, and that will be important when we create our journal entry. So let's go through an example. Heritage Cleaning Services provides a service to one of its customers for $300. This customer does not pay cash at this time, but promises to pay this amount in the future. So again, no cash is exchanged. The customer is promising to pay Heritage Cleaning Services $300 in the future. However, Heritage Cleaning has provided that service. So in this case, the accounts receivable is increased or debited, and service revenue is increased or credited. And I have an example of what the journal entry would look like. We always want to put our debit first, accounts receivable for $300. We then want to indent the credit, which comes second, and that would be service revenue for $300. Now, 2 months later, the customer, let's say, pays $200 towards this debt to Heritage Cleaning. So in this case, we've increased cash because we received cash by $200, which then, again, because cash is an asset account, an increase is debited. Accounts receivable, the asset is decreased by $200. When we decrease an asset account, we credit it. Now, revenue in this transaction is not affected because it was recorded when the service was performed and the accounts receivable was set up. So in this case, this transaction would look like this. It would be a debit of cash for $200 since we are increasing cash. We received $200 in cash, and we're decreasing the asset called accounts receivable because now that customer does not owe $200. He now owes just the remaining $100. So we're going to decrease or credit that accounts receivable account by $200. Now let's take a look at accounts payable. Accounts payable is just the opposite of accounts receivable. So just as a business can extend credit to its customers, other businesses can extend credit to a business. So again, this cleaning service, can have vendors that will extend credit to them. So when a business receives a service or product but does not pay for it immediately, they take on a liability. They have to pay for that service or product in the future. So it is a liability. This liability account is called accounts payable. So again, this is when a business owes a vendor money for service or product that was received by the business. So let's go through an example again. Heritage Cleaning, our business, Heritage Cleaning Services, purchases office supplies from one of its vendors for $500 with a promise to pay in the future. So we increase the asset office supplies by $500. The liability account called accounts payable is set up as well and is increased as well because we're increasing are payable. We owe something to somebody else. So again, an asset is increased via a debit, but a liability is increased via a credit. So in this case, what it would look like is our debit for office supplies, since we are increasing the asset called office supplies, we debit it for $500. We are increasing the liability called accounts payable. When we increase the liability, we want to credit that liability. Now, when Heritage Cleaning pays off that debt of $500, we'll pay it with cash. The Heritage Cleaning will pay it with cash. So cash is decreased and accounts payable is decreased as well. So the liability accounts payable, now that they're paying off that debt, is decreased by a debit, just the opposite of when they increase the liability. And the asset cash is decreased by a credit. So when we're paying off that liability called accounts payable, it'll look like this. We're decreasing the liability of accounts payable by $500. So we want to debit the liability called accounts payable. And we also want to credit cash, which is an asset. So we want to decrease cash by $500. So hopefully this has clarified things for you. The difference between accounts receivable and accounts payable. If you have any questions, please contact me. Thank you.